Imagine going to sleep on a normal Sunday night and waking up to a world that feels completely different. On September 15th, 2008, that's exactly what happened. A 158-year-old financial giant, Lehman Brothers, suddenly collapsed. Not slowly, not over months, but in just one weekend. People stood in shock as employees walked out of offices on Wall Street carrying boxes, their futures suddenly uncertain. But was this just one company failing? Or was something much bigger breaking behind the scenes? Why did banks suddenly stop trusting each other? How did one collapse spread fear across the entire world? And could this have been stopped? This is the story of the moment everything changed. If you want to understand the truth behind the biggest financial collapse, make sure to like this video and subscribe to Meltdown Diaries, because some stories are too important to ignore. A morning that changed everything. On September 15th, 2008, the news became official. Lehman Brothers had filed for bankruptcy. It was one of the biggest investment banks in the United States, and it was deeply connected to the global financial system. For many people, this felt shocking. Lehman was not a small or weak company. Most people believed it could never fail. That same morning, images spread quickly around the world. Employees walked out of the company's headquarters in Manhattan, carrying simple cardboard boxes. Inside those boxes were their personal things, but also the end of their careers at Lehman. These scenes became a powerful symbol of fear, uncertainty, and sudden loss. This was not just another business shutting down. It became the largest bankruptcy in U.S. history at that time. More importantly, it marked the moment when a financial problem turned into a global crisis that affected millions of lives. From safe banking to risky bets. In its early years, Lehman Brothers was known as a careful and traditional investment bank. It focused on steady growth and did not take extreme risks. But in the early 2000s, everything started to change. The housing market in the United States was booming. Home prices were rising fast, and banks saw a big chance to make more money. Lehman decided to take full advantage of this opportunity. The bank began buying large numbers of home loans, also called mortgages. It then turned these loans into financial products known as mortgage-backed securities. And these products were sold to investors and looked safe on paper, offering steady returns. But the reality was very different. Many of the loans inside these products were risky. They were given to people who did not have strong financial stability and might not be able to repay them. Lehman went even further by creating more complex products called collateralized debt obligations. These were sold around the world as high-quality investments, but they were actually built on weak and risky loans. The dangerous use of leverage. One of the biggest risks Lehman Brothers took was using heavy leverage. Leverage simply means borrowing money to invest more than you actually have. Lehman used this strategy very aggressively. For every $1 the bank had, it borrowed about $30 more. When the market was strong, this made profits look much bigger. The bank earned more money and grew faster. But there was a hidden danger. If things went wrong, even small losses could become very large. It was like building a tall tower on a weak base. From the outside, everything looked strong and stable. But inside, it was very fragile. One small shock could bring everything down. Lehman believed that housing prices would keep rising. As long as that continued, the system worked. But when the market started to fall, this belief quickly turned into a serious problem. Leadership and the push for growth. At the center of Lehman Brothers' strategy was its CEO, Richard Fuld. He was known for his strong and aggressive leadership style. On Wall Street, people often called him the gorilla because of how tough and determined he was. Under his leadership, the Lehman focused heavily on growth and profits. The bank wanted to stay ahead of its competitors, so it began taking bigger and bigger risks. For some time, this approach worked very well. Lehman made huge profits and became one of the most powerful investment banks in the world. But behind this success, serious risks were slowly building up. The bank was becoming more dependent on risky investments, especially in the housing market. These dangers were not obvious at first, but they were growing quietly in the background. In the end, these hidden risks would play a major role in Lehman's collapse. The housing market begins to fall. By 2007, the first clear signs of trouble began to appear for Lehman Brothers. Home prices, which had been rising for years, suddenly stopped going up. Soon after, they started to fall. Many people who had taken risky home loans could no longer afford to make their payments. Because of this, the value of mortgage-based investments began to drop. The products Lehman had heavily invested in, like mortgage-backed securities and collateralized debt obligations, started losing value very quickly. Investors became nervous. Confidence in the financial system began to break. Lehman was holding billions of dollars in these risky assets. As their value fell, the bank started facing serious losses. And because it had borrowed so much money, even small losses became very dangerous, pushing the bank closer to collapse. A race against time. By 2008, Lehman Brothers was in serious trouble. Its losses were growing, and its stock price had fallen sharply. Investors were losing trust, and the bank needed help fast. Even the situation was urgent. Lehman started looking for a buyer, hoping that another company could take over and save it from collapse. Talks began with Korea Development Bank, but no agreement was reached. Other companies showed interest at first, but when they looked closely at Lehman's books, they realized how risky its assets had become. They quickly walked away. Time was running out, and every hour mattered. The bank was on the edge, facing the possibility that no one would step in. The decisions made during these critical moments would determine whether Lehman survived or fell forever. The final weekend, on September 12, 2008, an emergency meeting took place at the Federal Reserve Bank of New York. Top bankers and government officials gathered to try to save Lehman Brothers from collapse. It was a desperate moment. Two banks, Bank of America and Barclays, expressed interest in buying Lehman. But both wanted protection from potential losses. They asked the government to back them up. The decision fell to Henry Paulson. He refused. After rescuing another bank earlier that year, the government did not want to create a moral hazard by saving Lehman. Without government support, the deals fell apart. Barclays could not get approval from regulators, and Bank of America chose to buy Merrill Lynch instead. Lehman was left with no options. Its fate was sealed. The collapse. In the early hours of September 15, 2008, Lehman Brothers officially filed for bankruptcy. With around $600 billion in assets, it became the largest bankruptcy in U.S. history at that time. The collapse was sudden and shocking. A company that had existed for more than a century, trusted by investors around the world, disappeared almost overnight. One weekend erased a financial giant from existence. Shockwaves across the world. The collapse of Lehman Brothers shook the entire global financial system. The Dow Jones Industrial Average fell more than 500 points in a single day. Markets around the world, London, Tokyo, Frankfurt, followed, and billions of dollars vanished almost instantly. But the biggest damage was fear. If Lehman could fail, no bank felt safe. Banks stopped lending to each other, and credit markets froze. Companies that relied on short-term loans suddenly couldn't operate, leaving businesses struggling to survive. The world's financial system was suddenly on very shaky ground. Panic spreads. The crisis spread fast. Our money market funds lost value because they held Lehman's debt. Major companies like AIG nearly collapsed, and big banks like Citigroup and Morgan Stanley were under heavy pressure. The entire financial system felt unstable. Government intervention. To stop the crisis, the U.S. government created the Troubled Asset Relief Program, a $700 billion rescue plan to stabilize banks and restore confidence. The government also helped save other major institutions, but by then, the financial damage had already spread across the system. A global recession. After Lehman Brothers collapsed, the world plunged into a severe economic crisis. The United States faced its worst downturn since the Great Depression. Millions of people lost their jobs and homes. The crisis did not stay in the U.S. It spread to Europe and other parts of the world, are forcing governments everywhere to step in and support their struggling financial systems. Public anger and loss of trust. The crisis changed how people viewed the financial system. Many felt banks took huge risks but were rescued with taxpayer money. This anger led to protests like Occupy Wall Street, where people demanded fairness, accountability, and a financial system that worked for everyone, not just the powerful. The aftermath. For Lehman Brothers, there was no comeback. The company went through bankruptcy, and its assets were gradually sold. Thousands of employees lost their jobs. CEO Richard Fuld was called to testify before Congress, and his reputation never fully recovered. New rules and reforms. After the crisis, new laws were put in place to make banks safer. The Dodd-Frank Act increased rules and oversight for our banks. Around the world, Basel III required banks to hold more capital and reduce risky activities to prevent future crises. The lessons. The story of Lehman Brothers teaches important lessons. Taking on too much debt can be very dangerous. Blind trust in financial systems can lead to big failures, and no company, no matter how large or powerful, is truly too big to fail. A collapse the world will never forget. The fall of Lehman Brothers was not just the end of a company. It was a wake-up call for the whole world. It showed how fast things can fall apart when risk is ignored and greed takes over. Lehman was once seen as too big to fail. But in just one weekend, it was gone. And the damage didn't stop on Wall Street. It reached workers who lost jobs, families who lost homes, and people who lost trust in the system. So ask yourself, could something like this happen again? Are we really safer today? Or are we repeating the same mistakes? Because the truth is simple. Markets go up, but they can also crash. Big companies look strong, but they can break. If you want more real stories that matter, like this video and subscribe to Meltdown Diaries, because the past still has lessons for the future.